Hello, debt warriors, and welcome back to another episode of Millennial Debt Domination. I'm your host, Katie O'Shea. June is Homeownership Month, a time to celebrate the many benefits of owning a home. Home ownership plays a crucial role in building personal wealth and strengthening communities across the country. It's a milestone that represents stability, financial security, and the pursuit of the American dream. To honor Home Ownership Month, today's episode is all about breaking into the housing market, a change many millennials and Gen Z are facing in today's economic climate. To help break it all down, I'm joined by Mike Russell, president and owner of Century 21 Signature Properties. Mike and I will be discussing the current housing market, interest rates, down payments, what first-time home buyers need to know, and much more. Now let's jump into my conversation with Mike. Hi, Mike. Thanks for joining me on the podcast today.
Thanks for having me. Appreciate it.
Yeah, I'm looking forward to talking to you today. We're going to be talking about breaking into the housing market. For June, it's Home Ownership Month. So what is the current state of the housing market and how does it compare to previous years?
Geez, I'd say affordability is a struggle. The affordability in the United States for homes is at one of its lowest levels in almost 50 years. So I would say the biggest struggle is affordability, which of course is a combination of interest rates, property values, and inflationary measures that make the cost of living more expensive.
And then, so affordability is a big challenge many millennials and Gen Z face when they're trying to buy a new house. Are there any other challenges that are more likely for those generations?
Sure. So something that goes in hand with that is an overall lack of supply, a diminished inventory of available homes really just enhances the lack of affordability. It's a simple supply and demand business. The less supply there is, the higher the demand. And so there are stringent entry factors in both financing and interest rates and price, but then there's also not a lot to choose from to begin with. So it's a very, very challenging time to find the home that someone's looking for.
Can you talk about interest rates and how they impact affordability as well?
Yeah, I mean, the higher the interest rate, the higher the payment, right? And so when we came out of that COVID period of time where interest rates were brought down to the lowest levels we've seen in decades, there was kind of a 2-year lull of fatigue for home buyers where they just could not believe that they were looking at a house 6 months ago, the payment would have been X, and now they're looking at them today and the payment is X times 2 or 3. That was very challenging, and it put a lot of people on the sidelines. It took a lot of active home buyers out of the market, and so interest rates have played a large role in most of the people transacting real estate today are people who absolutely have to buy or have to move versus the people who just want to. That's the effect interest rates has on people is you see people staying, younger folks staying at home longer with their parents. You see people not upgrading to the next level of home. And even if their family is expanding and they're having more children, or we see parents coming back to live with some people sometimes, is they're just expanding, their tight living quarters, is what interest rates create.
Yeah, I was actually going to say that because there are a lot of people who bought in 2020 when the interest rates are low, and now they're starting to have kids and more kids, and it's like they can't move right now, so they just kind of are making do.
Yeah, sure.
They have.
Yeah, you're seeing a lot of that. Housing situations are becoming more stressed in America, for sure. Yeah, there's no question about it.
And are you seeing any trends that make it easier or harder for young buyers to enter the market? Obviously, lack of inventory is one trend.
We've seen a slight relief in interest rates, kind of in micro bursts, from week to week. We're seeing some stuff under 7%, which helps. I'm seeing a trend of homeowners buying down the interest rate for the first year or two for the buyers so it becomes more palatable. But it's, outside of some workarounds like that, the rates, the fixed rates kind of are what they are. I'm not seeing a great reduction if you chose to do what's called an adjustable rate mortgage, where it's lower now, but in 5 or 7 years it may increase with the market. I'm not seeing, the juice isn't worth the squeeze. I'm barely seeing a 1 point reduction in adjustable versus fixed. So I can't recommend that product to many people.
How do economic factors like inflation and wages influence home buying?
Sure, inflation, obviously, if the cost of living is higher, then it becomes a lot harder to save money. It becomes next to impossible for so many households in America today to save a sufficient down payment in order to move forward with a purchase. And wages historically have not risen in the same fashion that the cost of living has. And so that has created sort of a stagnant wage. We don't see great increases in wages year over year in America. And so it's really largely dependent on inflationary things, because we can't depend on wages going up some significant amount, barring some further education or a great promotion or something like that. Wages are pretty stagnant.
So once a young home buyer has, saved enough and they're finally ready to buy a home, what are the first steps they can take if they're ready to buy that home?
Well, sure. The most important thing is to get with a lender that you trust and will guide you in the right direction. The most important thing to do to get prepared to buy a home is live within your means, right? Forget about what you see on social media and what other people claim to have, and all the shiny things that can get people's attention. And every generation falls for that to some degree. It's only become more challenging with social media and the way that we are all constantly flooded with some algorithm that seems to have us all deadlocked into what we like to look at. Live within your means. Keep your credit card balances at below 25% of the total credit limit. Save as much as you possibly can. Live at home as long as you can so you can save the money you need. Live within your means, and you'll be all right.
Yeah, and I agree with you with trying to not keep up with people and what you see them do online, because you don't know. They could be just still living with their parents too, or they could be drowning in debt. And sometimes I think, would I rather just go away for a week, or would I rather, buy a nice house,
Yeah.
rather save for that goal?
Yeah, there's most of the people out there, I would say, that flash a lifestyle online aren't wealthy.
Yeah.
Aren't wealthy. That's the reality of it.
Yeah, you don't know what's on their credit card bill
Or
at the end
or
of the
you can
day.
safely assume it's a lot, and
Mhm.
that's the reality of it is, and it's just not worth it long term. Like we all have an expiration date. Sooner or later, every one of us is not going to be here. And if I've learned anything in my life, it's that still the best way to long term sustained wealth is the acquisition of real estate over time. And the sooner you begin, the easier life becomes later in life. And I have twin nephews. They're 22, and I am consistently pushing them to prepare for home ownership and to purchase a property. And for those guys, probably a multi-unit, a 2 or 3 family, something they can live in for a period of time and then hang on to and use it as a passive income asset later on. So but it's challenging. They each make about $50,000, and they would do it together. And even with $100,000 income, it's very challenging to buy a home with today's prices, certainly in the Northeast.
And it's hard to tell kids that age too to be saving and not going out with their friends and doing all this too. It's like, "But my friends are doing this." So,
Yeah.
especially at that young age, it's hard.
It's next to impossible. It really is. And it's only gotten more challenging. I'll tell you, one of the things that I see really affecting the youth is the ease in which they can gamble on sports, and how quickly they can open an app and secure a 10 leg parlay and change their entire relationship dynamic with sports. And it is constantly right there at their fingertips. And I see a lot of kids making the mistake of thinking that a $5 parlay or a $10 parlay is no big deal and no big deal. But, over time, that's the compounds. Yeah.
I was just gonna say over time, it just adds up. It's the same as and that's the same as, like, getting coffee out every day. It's the same thing. It just adds up over time.
Yeah.
So,
It's the same, and it's tremendously addictive, and it does not get better later in life. That gambling bug sticks with you.
yeah, exactly. You could be putting that $5 towards a down payment on a house one day. So how much should prospective buyers aim to save for a down payment?
So there are, look, the easy answer is as much as humanly possible, right? Live below your means, save as much as humanly possible. And look, there are programs intact, both regionally, statewide, and federally, that assist with down payment. And so there are ways to see if you apply for that. They're all income and debt to income based ratios that come into play. There are even geographical concerns that come into play and whether or not you can qualify that. So there are great down payment assistance programs, but you don't have to save 20% nowadays to buy a home if you're going to buy a residential property. As a first time home buyer, 3.5% of the total purchase price is what you're aiming for to have as a down payment. But then, of course, there are closing costs. There are closing costs that come into play that most people, without great guidance, whether it's through a great lender that you trust, through a great real estate professional that you trust, the reality is there are so many costs that come up while purchasing a home that aren't included in that down payment amount. And so we can talk about those if you want. Yeah.
Yeah, let's go ahead and we could talk about it now.
Yeah, sure. So when you're purchasing a property, you have to get it, and you're using a loan, you have to get an appraisal. You have to, you don't have to, but I highly recommend getting a home inspection on the property. So those two combined can be over $1,000, $1,200, and that's even prior to going to the closing. And then closing costs, things that come up that a lot of people don't think about is the bank will make you put escrow payments in escrow 2 or 3 months worth, which include maybe insurance and taxes at the closing. So in addition to your down payment, you may account for, as much as $2,000 in prepaid escrows that you have to put in place at the closing, which will pay your property taxes in that first quarter. And then also you have to pay your insurance binder in full for the year prior to, and the insurance rates in America have just gone through the roof with all of the natural disasters happening at either coast. The reality is the entire country bears that expense when claims go up. Those insurance companies raise their rates, and I tell you that my insurance went up 100% this year compared to last year, my homeowner's insurance. And it's simple residential home, nothing crazy. Maybe 2,800 square feet. My property insurance bill is $3,900 this year.
Yeah, and it almost doesn't even matter what region you live in nowadays because it's hidden everywhere.
Everyone's bearing the expense. Yeah.
What are the most important factors lenders consider when approving a mortgage?
So 2 years work history, right? You need to be able to provide that you've had a work history for the last 2 years. So you need to produce 2 tax returns showing work history. There are exceptions to that rule. If you are in a specialized education, doctor, dentist, a trade, HVAC, something, a plumber, an electrician, there are instances where the lender will consider education time served, right? And so you don't necessarily need 2 years working as a doctor. If you just got out of med school and now you're a doctor, they can loop some of that in as time served on a job. DTI, debt to income ratio, right? They want to see 45% or less, typically, where your total debt, including the soon to be mortgage payment and any debt obligations that you have per month, whether it be credit cards, car loans, student loans, anything like that, all that money shouldn't account for more than 45% of your total gross monthly income. So DTI, debt to income ratio, credit score. There are programs that will allow a home a financing approval that allow for less than a 500 credit score. But honestly, I would never recommend to somebody who has less than a 600 credit score that they buy a home, because I've seen the other side of it. I've seen tens of thousands of people firsthand lose a property to foreclosure. I've seen a lot of people get into something that they truly can't afford. And so I would say I wouldn't buy a house unless I had a 620 or better credit score. My DTI was significantly lower than 45%, and I had a solid work history. But those are the things that they look at: DTI, credit score, and work history.
I could see that being, some of that being tricky for
It
young buyers,
is.
especially the student loan thing, because I know a lot of my people I know are just not even close to being done.
Yeah, and it's one of the things. It's a slippery slope, but one of the things that you can do if you have a federally granted student loan, a federal loan, is as you're building your life and you want to purchase a home, you can early on choose the lowest possible monthly payment for that loan. And then you can always go back once you become established and increase that monthly obligation. But in terms of getting your DTI down to a manageable place where you can become bankable in the traditional banking world, keeping that encumbrance as low as possible in the beginning, if you have the responsibility and the wherewithal to go back once you're established and increase that monthly obligation.
So once a young home buyer has a low DTI ratio and they have everything ready and they're ready to buy, how can they compete in this competitive market? Is there anything to like make them stand out?
It's tremendously challenging, right? What I'm actually seeing a lot of people do, and the parents out there will love me for suggesting this, is we last year actually 43% of the real estate transactions we did, the highest number ever, were cash. And what I'm seeing a lot of, believe it or not, is I'm seeing parents put up the cash for their children to buy their first home, and with the agreement that once rates settle down, refinance us out, give us our money back, and then you can be in a loan. And that I'm seeing so many people doing that. Obviously, not everyone has that ability, but I've seen parents really go above and beyond in this environment to make their children a more aggressive, viable buyer in the marketplace. So there are, but it's tremendously challenging. That's what creates bidding wars. Please, when demand is so high and supply is limited, that's what keeps inching the prices up, is that the buyers feel, well, the only way I'm going to be able to win is if I blow everyone else out of the water. And that's a tremendously slippery slope too. There is no guarantee for any of us that values will continue to increase. And I think that I've been doing this for 30 years, so the logical thought is converse to that. Values are going to begin to come down. And I believe that. I don't think we're not on an ever rising scale of property values over long stretches of time. 20 years from now, yes, values will be higher than they are today. But 3 years from now, I'm not sure about that.
No, yeah, the cash is what really puts people over the edge
It is.
nowadays. It's
It's
just
it's a non-comparable product. If I'm an FHA buyer and I submit an offer that is equal to or even $20,000 higher than a cash offer, if I'm the seller, I'm taking the cash offer. And that's one of the struggles that people face. And but I'll tell you, you buy none of the houses you don't try to buy, none of them. And that's where the fatigue comes in. Is people, we dealt with hundreds of people who submitted dozens of offers and got denied. And listen, it's loosening up. It's not like it was during COVID. It's certainly not like that to that degree. It was even worse, of course, when rates were 2.5%. But it's lessened. That kind of strenuous pressure. So I think that look, it's cyclical. The real estate market always is. It's cyclical. It comes in cycles, and there are waves and there are troughs. Yeah.
we talked about FHA loans. Are there any other loans or assistance programs available for first-time home buyers?
Absolutely, sure. And there are great down payment assistance programs that are regional, statewide, and national. where you can actually borrow your down payment in addition to the principal purchase amount. And so there are great 100% financing options here in Massachusetts. There are great state programs. A lot of them are like metropolis based, where if city based, in different city centers, and so they have regional, state, and national. And the national has a great USDA program where you can borrow 100% if it checks off the geographical boxes. And so there are checklist items that determine whether or not you qualify, both geographical, style of home, as well as DTI, income, things like that. Speaking with a great lender, and they'll be able to guide you into those places.
You touched a little bit on closing costs earlier. That's a hidden cost that first-time home buyers should be aware of. Is there any other ones that we should be aware of?
Well, those closing costs, private mortgage insurance, right? When you get an FHA loan, get an FHA loan or something less. When you put less than 20% down on a property, the bank requires that you carry something called private mortgage insurance, which is insurance against you defaulting, effectively. And it's a policy, and it can be hundreds of dollars a month on top of your mortgage payment to ensure the bank's position on their collateral, because they are in such a leveraged place, higher than an 80% loan to value situation. And so the things that I'm describing that may be happening a little bit about people coming close to being in a potentially negative equity position, banks are deathly afraid of that. They don't want to be in a situation where their collateral, if foreclosed on and retained by the bank, that they wouldn't be able to make themselves whole on the resale of it.
What's the biggest piece of advice you'd give to someone preparing to buy their first home?
Forget about what you think everyone else in the world thinks about what you're doing with your life, what you have, and what you do with your time. Understand that what's important is how you feel inside, not what the rest of the world thinks or what you think they think. So don't try to put out any kind of persona out there that costs you a lot of money to put out. Live within your means, save some money, and protect your credit. It is one of the most important things in all of America over the course of your life. Having great, reasonable, responsible looking credit will open up doors for you in your life that you can't even begin to truly understand today, but they will open up doors and make your life far easier.
I think you answered all my questions. So, Mike, thank you so much for joining me on the podcast today.
No problem. Thank you very much for having me. Have a great day.
Yes, thank you. Buying a home is a major milestone, but with rising inflation and stagnant wages, it can feel out of reach. The key is to focus on your financial journey. Keep saving, manage your debt wisely, and don't get distracted by what others are doing online. Everyone's financial situation is different, so comparison won't serve you. If home ownership is your goal, stay committed to your savings plan and keep your debt to income ratio low. With patience and persistence, you'll get there. And with that, we wrap up another episode of Millennial Debt Domination. Don't forget to subscribe to the podcast wherever you're listening. And if you're listening on Apple Podcasts or Spotify, please rate and review us there. I'll talk to you next time, Millennials, Gen Zers, and everyone else tuning in. Bye.